It has not been a good time to be a Pfizer shareholder. After the boom during the pandemic, the stock has just been going down and down and down. Currently the dividend yield is 6%. I still don't think the stock is a good buy, but let's look into it why that is. First of all, when we look at revenue growth, there has been no revenue growth. There was the bump during the pandemic where they were able to sell their vaccine, which they haven't even developed themselves. It was a cooperation with BioNTech, but overall we can see revenue mostly flat, some years up, some years down. It is basically not moving. And we can see the same with the free cash flow. It has usually been hovering around 15 billion. Right now it has been a bit lower, but it's usually around 15 billion. No change aside from the pandemic. So when you look at that, you might think, oh, Pfizer, 15 billion in free cash flow doesn't really move much. 10% yield for a non-growing company. Not that bad. Well, yes, that is if the revenue growth was organic and the free cash flow would be available to shareholders. But no, they do a lot of heavy acquisitions. 16 billion, 18 billion. 10 billion, 19 billion, and just last year, $43 billion. They bought Segan. I'm not a doctor. I do not know how much the medicine of this company is worth. I'm looking at the portfolio that they have right now. And in total, they make $2.2 billion in revenue. They have some drugs in the pipeline, but is this company worth over $40 billion? They're spending around $8 billion per year on average in acquisitions. That's around how much they spend on research and development. So this 15 billion in free cash flow, that does not belong to you. That is needed to sustain the revenue. Sustain, not grow it. Remember, revenue has not grown at all, basically, since 2014. Inflation adjusted, it has been down. And to maintain that, they had to spend another $8 billion per year, just on acquisitions. Sure, you had some share buybacks over time. They have stopped now, and that makes sense. They just spent $43 billion. If we look at their debt, it has basically been growing since 2014. All the way to 2020, where they had their one breakthrough, the COVID vaccine. They have used all that cash to pay down debt. And now, immediately, as soon as they're debt-free, they acquire another company and then more debt than ever before. And that makes me think, all the share buybacks before were funded through debt. From 2014 to 2019, they took on $40 billion of debt. So they didn't even have money for the dividend, really, that they paid out. And then I'm looking at what made them money in 2023. COVID vaccine. The patent for this product is gonna expire soon. The Prevnar family also has a lot of old vaccines. So I already see that we'll have to do more acquisitions again if their pipeline doesn't work out. So yes, they're paying out this dividend and it's slightly growing, but it won't grow for much longer. On average, they make around $2.3 in free cash flow per share, ignoring it right now. Right now, the free cash flow is massively down. But if it returns to before, $2.30, $1.60 in dividend per share, they still need to do the acquisitions. They can't just take on debt forever. So you're not going to have a growing dividend here. It's going to take a long time for them to deleverage this. Sure, they have some cash on hand. They're not going to go bankrupt. They're going to be able to pay this down even if they have to cut the dividend. Unlikely, but maybe they will. I don't see where the growth in the company is going to come from. I don't see the cash flows. But hey, let's do the calculation. Let's see what we would be willing to pay for Pfizer. Now when we look at Pfizer, let's say they recover to $3 in free cash flow per share, which would be quite a growth to what they had before, but let's just give them the optimism that the new acquisitions they did are gonna increase free cash flow. Payout ratio of 50% with a little deduction due to taxes. Remember, they can't increase the payouts right now that much, they need to pay down debt, and they need to have a lot of free cash flow for the acquisitions. What are the growth rates? Historically, Pfizer has not had great growth rates, and also a lot of their important products are running out, at least a patent, so let's call it a 2% growth rate for the next 10 years. 13 multiple, and it's not a fast growing stock. The pharma business is very risky, litigations are often there, or just your pipeline can go empty and you get no approvals. With that, we would come to $27 a share. Currently, it's trading at $28.50. Not a great buy, but also not a horrible buy, but I would say these are pretty optimistic assumptions, especially with $3 in free cash flow per share. I don't think that's going to happen. I think they're going to stay at maximum of 2 and the 2% growth rate over the next 10 years. That is only going to be able if they're going to do buybacks after they leverage down. Now, what if it goes better? 15 multiple and 4% growth rate, then $34 a share. Then we would have an okay buy under our assumptions. We would have a good margin of safety. But remember, these are very optimistic assumptions. Now, what if they recover to $3 per share, but they don't grow? No buybacks, they can't, and basically everything they buy just replaces their existing pipeline. 10 multiple for a non-growing company is still kind of high, but let's just keep it like that. $19 a share, a huge drawdown. Overall, I don't want to touch Pfizer, not at these prices. It hasn't grown in 10 years. Now it has a huge amount of debt. It needs to do constant acquisitions to even keep their revenue. So overall, I don't see the value in this company. Yes, 6% dividend, but I want more than a 6% return. I could currently buy government bonds, which are yielding 5.5%. So, no thank you. I'm gonna skip this one. What do you think about it? Write down below. Have a good day.